Jim asks, what's the best way to account for personal and corporate use of vehicles for Schedule C profiles? Well, Jim, it depends. My favorite answer. So what it depends on is how you determine creditworthiness. Global debt coverage ratio, entity level debt coverage ratio, or net cash flows from all activities combined with a personal debt to income limit. Now, you went on to say that you normally remove the auto debt from the client's cash flow if the expense reflects on the Schedule C. But you wondered if it would seem more appropriate to include the debt personally and then adjust the income picture to add back this expense for personal use, partial use of that vehicle. I'm not sure I do either, depending on the use of the vehicle. So here are some choices with pros and cons. First, global debt. So some lenders put all debt, business and personal, on one global debt list. Now, if that's the case, just add back interest from the Schedule C and enter the auto loan payment on your global debt list. Be aware that on occasion the borrower enters the car interest on line 9, car and truck expenses, instead of line 16, interest. And then it's just a little harder to spot that interest expense. The complication, though, is your plan to add back the car and truck expenses if you go this route. Car and truck expenses may include interest expense, but also includes actual out-of-pocket expenses for gasoline, oil, repairs, insurance, and such. So while some of that may not be impacted by mileage put on the vehicle for business, insurance, for example, some of it certainly is. If I drive 10,000 miles a year for business, of course there are extra costs for that. So consider adding back the interest and putting the debt on the global debt list. But you may need to leave the car and truck expense as is. Now, how about net cash flows from the business? Some lenders subtract business debt from the business entity to get net cash flows personally available. And if they don't force a debt coverage ratio of more than 1.0 on the business, then this approach gives you a higher debt coverage ratio overall or a lower debt to income ratio, whichever you're using to qualify your borrower. Now, as with the global debt approach, if they've included car and truck expenses on line 9 and it is actual out-of-pocket expenses for gasoline, oil, and insurance, I leave that in either way. Those are real costs, and if they're being honest about their usage, they're additional costs related to the business use. Now, a common adjustment to car and truck expenses is to add back a third of it if they're using standard mileage allowance. That's because part of the allowance is for depreciation, and we add back depreciation because it is non-cash. Now, this adjustment can be made whether you're using a global debt or a net cash flow approach. If you want more on Schedule C and depreciation, there are some links below to our online modules. I know you will love them. Enjoy.